Hello everybody, welcome to Trio's All About Credit workshop. Thanks for being here. Today we're going to talk a little bit about what credit is, how you can build credit, and why this even matters in the first place. The first concept that we'll go over that's really important to understand when it comes to credit is credit history. A person's credit history is kind of a measure of their ability to repay debts on time. So anybody who has ever taken on debt, whether that is credit card debt, student loans, car loans, a mortgage, any kind of debt, any money that you borrowed that you have to pay back, if you have taken on debt, then you will have a credit history as well as a credit score. The credit score is a number that kind of represents what your credit history is looking like, whether it's looking pretty good or maybe not as good. And that credit score can range from about 300 to 850. Other things that are included in a person's credit history would be the duration of any loans, how long you've had them, and how long you're going to be paying them off. The amount of available credit that you have, which would be, let's say, on a credit card, if you have $5,000 of available credit, that is money that you could potentially spend on that card. Also, the number of recent hard credit inquiries. This means anytime that somebody looks up your credit score, if you're, say, applying for a new loan or a new credit card, anything like that would be a credit inquiry, and a lot of credit inquiries in a recent period of time could actually lower a person's score. So that's why that's included in credit history. And then also if a person has any bankruptcies, any bills that have gone to collections, or anything like that. All of these different factors are taken into account for a person's credit history. So why does credit matter? Why is this something that we should learn about or should be thinking about? There are several different reasons. First, if you want to ever get a new lease at like an apartment, take out a car loan, open a new credit card, anything like that where you might be potentially taking on debt, or someone is checking about your credit history, then having a good credit history is going to help in that scenario. Usually when you apply for, let's say, a new lease at an apartment or a new loan, they're going to look at your credit history to evaluate if they want to give you that opportunity. If you do have a low credit score, you might be able to get that loan or get that lease, but sometimes what you'll see in those scenarios is a higher interest rate on any maybe loans that you take out. Let's say you're buying a car or making a large purchase, you might have more interest owed over time, which would increase your overall debt or the overall amount of money you pay long term if you have that lower credit score. You also might be getting a lower credit limit if you're getting a credit card. That would mean that you would have less money available to use that card for. So that could be like, let's say, a $200 or $300 credit limit. That would mean that you can only spend a little bit of money on that card compared to a card with a higher credit limit if you had a higher credit score. So to understand a little bit more about credit history, we have a couple different categories here. You might have no credit history if you don't have any debt, any loans, any credit cards, any student loans, stuff like that. But if you do have a credit history, you might have what we would call a good or high credit score or a good credit history, or a poor credit history or low credit score. We have a little graphic on the slide here that shows that we have this range from 300 to about 669 as a credit score, is kind of in that lower end. Our good range is 670 to 739, and then very good to exceptional would be that 740 to 850 kind of range. If a person has good credit or a good credit history, what that will probably look like or why they would have that situation would be they have a history of paying off any of their debts on time. Either they're paying off that debt entirely over time, or they're just continuing to make regular payments on a loan that they have, or on their credit card. If they have a credit card or multiple credit cards, they are rarely using more than 30% of that available credit. So let's say for easy math, if you have $100 as your credit limit, $100 is what you could spend on a card, you're not putting more than 30%, or in this case $30, on that card at any given time. Going over that 30% can start to drop a person's credit score. So using less than 30% is a good way to keep your credit in check. And if you do have good credit, you likely won't get a lot of trouble when you're applying for loans, applying for new credit cards. Getting those loans or getting those opportunities is probably going to be a little bit more accessible, and you might not have as much interest as somebody with a lower credit score. So you might have lower interest, you might get a higher credit limit, it might be easier to get loans or to get credit cards, especially if you're making big purchases like a car or a house or any kind of like large home appliances or anything that you might be kind of spending quite a bit of money on or taking out some debt for. On the lower end of our credit score range, or what we might call a poor credit history, what this could look like is if a person has a lot of outstanding debt, they owe a lot of money to a lot of different places, or maybe they just owe a lot of money on one credit card or something like that. Possibly if they have not paid their bills on time, like if they have a lot of late payments on a credit card, or they're going over that 30% or using up more of that potential credit on their card. They're like maxing out their credit cards, spending all of that money that is on that account. All those things could potentially drop a person's credit over time. It also can be a sign that a lot of people have recently looked at a person's credit history. We've seen a lot of those hard inquiries on that person's credit. Maybe that person is applying to a lot of credit cards, or they're applying for a lot of loans, and there's just a lot of organizations or people checking their credit history. Sometimes that happens because a person is, in a financial situation where they are like, oh, I need to get more credit cards, I need to take out a loan, like my life situation, my financial situation is feeling a little bit rough right now. Creditors will see that and say, okay, maybe this is not someone who could pay back these debts, so they might deny that person a new credit card, or they might give them a higher interest if they do approve them. They might give them a lower credit limit, so there's less money they have available. There's a lot of different outcomes of that situation. But it is possible on this end where someone has lower credit that they could be completely denied, a new credit card or a loan, that they might have those higher interest rates, they might have those lower credit limits, and really it's just not an ideal situation for a lot of reasons. So we'll talk about kind of what we can do about this. So first, for anybody who has no credit, we want to talk about how to build a healthy credit history, a good credit history, before we talk about kind of recovering if you're in a situation where maybe your credit's not looking quite as good as you would hope. So if you have no credit history, if you have no credit cards, no loans, no debts that you've taken on, that's totally fine. Everybody starts this process at some point. And so a lot of the time, students or people that are new to kind of building credit, they don't have a credit score yet, they don't have a credit history yet. That can make it pretty tough to get approved for a loan. It can make it tough to get a good credit card. And so what a person can do in this situation is to take on like a very small amount of debt, let's say with like a student credit card or a low credit limit credit card. They can, spend maybe just a little bit for, gas once in a while for their car, or they go out to eat once in a while and they just use that credit card for like $15, $20, maybe $30 per month, and then they pay that back on time every single month. Just kind of building this history very slowly, taking on a tiny amount of debt, $15, $20, $30 at a time, and then paying it back regularly. That's a really good place to start building credit. When you're new to building credit, you probably won't be getting approved for a credit card that has a lot of money on it, right? You wouldn't be getting potentially like a $5,000, $10,000 credit limit. It's probably going to be in like that $500 or lower kind of range. And so you want to stick to, under that 30%, spending, maybe like $50 to $100 at the absolute most, depending on your card, just to sort of start building that history. Other things you can do as you're starting this process is to, of course, try to pay your bills on time every single time. A lot of the time you can set up auto pay options, which can be really helpful to just pay off that entire balance automatically and you don't even have to think about it. But let's say if you are, leaving a little bit of balance on the card, you can't pay that entire amount every single time. You can, keep just paying those minimum payments regularly, or even a little bit early. even if you make a minimum payment but it's ahead of the due date, that can also help build your credit score up. And then if you are able to, depending on what your debt looks like, if it's loans, say you have a car loan that's $100 a month, you can pay a little bit more than that necessary minimum payment. That can also bring up your credit score as well. So let's say you pay $120 a month and you pay that bill a little bit early. All of those things can build your credit and also increase your credit score by giving you that good history. If your credit score and your credit history are already established and maybe you are not feeling so good about them or you just want to make them even better, there are a lot of things that you can do to improve your credit. This can take some time. It can take, months to years depending on your situation. But one resource that you can use, of course, is to see a financial advisor. There are a lot of free financial advisors at various banks and credit unions, so definitely something to look into either with your credit card provider, your loan servicer, or your bank or credit union. A lot of them have financial education that you can access for free. So you can always talk to an expert about kind of what your own situation looks like, since this is different for everyone. But beyond that, you can also look into consolidating credit card debt. If you, say, have credit card debt on multiple different credit cards, this is an option to lock in a lower interest rate for your total amount of debt. So let's say if you're paying 10% on one card and 4% on another, sometimes they can do an averaging kind of process, or they can just put you on a lower interest rate overall if they consolidate that debt. It looks a little bit different for everyone, but that is an option. Another thing you can do to improve your credit is to pay a little bit more than necessary, more than that minimum payment that's required. That is going to be better for your long-term credit history than just paying off in one big chunk. So let's say, you've got student loans and you get like a really big scholarship and you want to just put like a huge chunk of money towards your loans. If you pay off all of your debt or a huge chunk of your debt in one big big payment, that can look a little bit worse to creditors than consistent payments over time, which sounds kind of silly, but what they like is to see that consistent financial responsibility. So those large payments can actually drop your score. Again, seems silly, but if you make that minimum payment or a payment that's a little bit above that minimum payment, on a consistent basis, either on time or a little bit early every month, that consistency is really what your credit history is looking for. If things are really not looking so good, you can also contact a credit repair company. Sometimes they can remove certain activity from your credit history if there are things that maybe are related to difficulties during the pandemic or health issues or a variety of different kinds of kind of extenuating circumstances. Sometimes there are things that are just genuinely mistakes, or even in the case of like identity theft, if someone else opened a card in your name or used your card in a fraudulent way, all those things could potentially happen. So contacting a credit repair company could be one of those other resorts you could take to try to improve your credit. And that is all for this workshop. As usual, feel free to ask any questions. You can always reach out to Trio and we can kind of give you some extra guidance along the way for your own personal situation. But thank you for attending this workshop, and we hope to see you at another one soon.